Homeownership is a cornerstone of the American dream, representing stability and success. Mortgages have shaped homeownership for centuries. They are loans designed to facilitate property purchases, spreading the cost over time. This journey explores mortgages from ancient origins to their modern impact. Mortgages have ancient origins. In ancient civilizations, agreements similar to modern mortgages were made. Civilizations needed financial instruments for land ownership and economic activity. In the 5th century BC, the Persian Empire had a system where land was pledged as security for loans. These early agreements show an understanding of property as security. The Roman Empire formalized mortgages with a structured legal framework. Roman law introduced hypotheca, allowing property to be pledged without surrendering possession. They also introduced foreclosure, enabling lenders to seize property if loans defaulted. These principles laid the foundation for the complex mortgage systems we have today. Fast forward to medieval England, a period marked by feudalism and the growing importance of land ownership. The term mortgage has medieval roots, derived from the Old French phrase mort gage, meaning dead pledge. Borrowers, often peasant farmers, handed over land to lenders until the debt was repaid. If the loan wasn't repaid, the land was forfeited to the lender permanently. Lenders, often wealthy landowners, held considerable power in these arrangements. Legal reforms introduced the concept of equity of redemption, allowing borrowers to reclaim their property. Mortgages in the New World. Settlers brought the concept of mortgages from Europe. These agreements were crucial for new communities and symbolized opportunity. Early practices were informal, based on personal agreements. As the nation grew, standardized mortgage practices emerged. The 19th century saw the rise of savings and loan associations. These institutions expanded homeownership opportunities. The Great Depression led to widespread mortgage defaults. The crisis prompted federal intervention to stabilize the housing market. The rise of modern lending giants. The 20th century saw the rise of modern lending institutions. The federal government created institutions like the FHA and Fannie Mae to stabilize the housing market. These enterprises standardized mortgage products, transforming the mortgage industry. Post-war commercial banks like Wells Fargo and Bank of America expanded their lending operations. These giants made homeownership more accessible to the masses. The rise of these institutions coincided with the development of FICO scores. Deciphering the mortgage cost equation. Understanding the costs associated with mortgages is crucial. From interest rates to closing costs, every detail matters. The interest rate is a primary determinant of your mortgage cost. This rate represents the cost of borrowing money from the lender. Factors like market conditions and creditworthiness influence interest rates. Higher credit scores generally lead to more favorable rates. The term of your mortgage also plays a significant role in the overall cost. Longer terms mean lower monthly payments but higher total interest. Shorter terms offer less interest but higher monthly payments. Closing costs, including fees and insurance, also impact the total expense. Let's break down these costs and see how they impact homeownership. Navigating the lender landscape. The American mortgage market is vast and diverse, offering a wide array of lenders. Choosing the right lender can make a significant difference. Large commercial banks dominate the mortgage market. They offer the convenience of managing multiple accounts under one roof. However, their standardized practices may not cater to unique financial situations. Credit unions offer competitive rates and lower fees. Mortgage brokers connect borrowers with suitable lenders. Online lenders offer digital convenience and faster processing times. With so many options available, it's essential to know what to look for and how to navigate this landscape. A tale of two systems, US versus global models. Mortgages vary significantly around the world, revealing unique approaches to homeownership. A key difference is the prevalence of fixed-rate mortgages versus adjustable-rate mortgages, or ARMs. In the US, fixed-rate mortgages dominate, offering predictable monthly payments. In contrast, many European countries favor adjustable-rate mortgages. ARMs offer lower initial rates but can lead to fluctuating payments. Homeownership and wealth. Owning a home is a key factor in building wealth. Buying a home versus renting involves weighing monthly payments, property taxes, and maintenance costs. Homeownership shapes long-term wealth and influences social mobility. It represents a path to building equity, crucial for accumulating wealth. Mortgage payments gradually increase your ownership stake. Growing equity acts as a forced savings plan tied to home value. Mortgage payments build an asset that can appreciate over time. Appreciation potential drives the wealth-building aspect of homeownership. Rising property values increase equity, leading to financial gains. Homeownership offers tax advantages that enhance wealth building. In the U.S., mortgage interest and property taxes are deductible. Tax benefits free up income for savings and investments. Homeownership provides financial stability and opportunities for future growth. It remains a cornerstone for wealth accumulation and financial security. The socioeconomic tapestry of homeownership. Homeownership is deeply intertwined with social mobility and socioeconomic status. Owning a home is seen as a marker of stability, responsibility, and achievement. Studies show a strong correlation between homeownership and higher socioeconomic status. Homeowners tend to have higher incomes, greater net worth, and more stable employment. Homeownership opens doors to social and economic benefits for families and communities. It fosters a sense of belonging and contributes to the socioeconomic fabric of society. However, systemic barriers can perpetuate socioeconomic disparities in homeownership access. Economic shocks and the mortgage effect. Understanding the impact of economic downturns. The 2008 financial crisis highlighted the profound impact economic downturns can have on the mortgage market. Lax lending standards and subprime mortgages led to a wave of foreclosures, devastating communities. Home values plummeted, leaving many homeowners underwater, owing more than their homes were worth. Countless families faced foreclosure, losing their homes and damaging their credit histories. Foreclosed properties flooded the market, further depressing home values and impacting responsible homeowners. Understanding these effects helps in navigating challenging times, underscoring the need for responsible lending and greater transparency in the mortgage market. Navigating the interest rate labyrinth. Interest rates are the lifeblood of the mortgage market, influencing affordability and shaping decisions. Understanding how these rates are determined is crucial for navigating home financing complexities. Central banks, like the Federal Reserve, set benchmark rates that lenders follow. In a sluggish economy, lower rates make mortgages more affordable. When inflation rises, higher rates can cool the economy and curb prices. This can lead to higher mortgage rates, making borrowing more expensive. Navigating this labyrinth can save money and make homeownership more affordable. A global view of mortgage markets. The global mortgage market offers diverse perspectives, with the American system often serving as a reference point. Comparing different markets provides valuable insights into best practices and innovative approaches in financing homeownership and addressing housing affordability. In many European countries, adjustable rate mortgages, or ARMs, are the norm, offering lower initial interest rates, but with fluctuating monthly payments. Canada has a robust system of government-backed mortgage insurance, allowing banks to offer mortgages with lower down payment requirements. Bridging the gap, government interventions and affordable housing initiatives. Access to affordable housing is a fundamental challenge, especially for lower-income families. Governments play a vital role in making housing affordable through various initiatives. Down payment assistance programs offer grants or low-interest loans to eligible home buyers. The FHA offers insured mortgages with down payments as low as 3.5%. Developing and preserving affordable housing units is another key strategy. These initiatives aim to keep housing affordable for low and moderate-income households. Down payment assistance programs help make homeownership more accessible by providing financial support to those in need. Governments and nonprofits offer grants or low-interest loans to make homeownership more attainable. The FHA's Section 8B program allows housing vouchers to be used for mortgage payments. Many states and municipalities offer DPAs targeting specific populations like first-time buyers and veterans. Research and counseling are crucial to finding the right DPA for your financial situation and homeownership goals. Beyond U.S. borders. Innovative approaches to housing affordability. Innovation is key to addressing housing affordability. A global perspective reveals diverse policy approaches and creative solutions. Some countries prioritize renting for flexibility and affordability, especially for young adults. Germany has a strong social housing sector and tenant protections. Singapore offers affordable home ownership through subsidized public housing. In the Netherlands, housing associations provide affordable rental housing. These examples show how innovation is driving change in housing affordability worldwide. Navigating a changing landscape. The mortgage landscape is constantly evolving. Staying informed and adaptable is crucial in navigating these changes. A key trend is the increasing digitization of the mortgage process. Online lenders offer streamlined applications, faster approvals, and greater transparency. Big data and AI are transforming the financial services industry. Lenders use algorithms to assess creditworthiness and personalize loans. The mortgage industry is adapting to climate change with risk assessments. Mortgages shaping financial futures. From ancient agreements using land as collateral to today's digital platforms, mortgages have shaped societies and individual financial well-being for centuries. Homeownership, often facilitated by a mortgage, empowers generations to build wealth and establish roots within communities. Leveraging property as collateral has fueled economic growth and innovation in financial services. However, the path to homeownership is not without its challenges. The 2008 financial crisis highlighted the interconnectedness of the mortgage market and the economy. Reforms have aimed at ensuring a more stable and equitable housing market. Navigating the path ahead. The future of mortgages is filled with opportunities and challenges, signaling potential shifts in how we access home financing. The increasing digitization of the mortgage process promises to streamline applications and empower borrowers. The rise of big data and AI presents both opportunities and challenges. AI-powered underwriting can make lending decisions more efficient, but raises concerns about biases. The mortgage industry must adapt by incorporating climate risk assessments into lending practices. Navigating this path requires knowledge, adaptability, and a forward-looking approach, understanding mortgages from their historical roots to their evolving role.